Here is the point where we talk about the things that we wish we knew prior to us starting our policies, and we're 10 years into this process, okay? What I wish I knew back then is 10 years ago, was the cheapest to insure 10 years ago. I'm more expensive to insure now because I'm 10 years older, and that's going to continue to change. So what I know right now is that I am putting way more money into the death benefit piece of my life insurance policies than I did 10 years ago. Because again, recognizing now Darius and I have had children, now we make more money, and realizing that if any of us were to go, we want as much money as possible.
Most people buy life insurance just for protection, like death benefit, but you could be leaving other opportunities on the table. So in today's video, we're going to discuss how to buy your next policy with your goals, your specific goals in mind.
Absolutely. So let's jump into it. Ask yourself 3 questions right now. Leverage, liquidity, longevity. What's important to you? We call these the 3 L's: leverage, liquidity, longevity. Let me break this down for you. Longevity. Does longevity mean 10 years, 20 years, or does longevity mean coverage for the rest of your life? Everyone's different. Liquidity. Do I need access to cash? Do I want other alternatives to cash as opposed to the banking institutions? Right? And then leverage and liquidity, they kind of go hand in hand. Do I want to be able to leverage my cash in ways in which I don't have to literally use my cash? I can use other people's money, or OPM.
Right.
Did you even know you could have this conversation when you're considering life insurance? Well, newsflash, we're going to go through all of this because, like Darius said, it isn't just about the death benefit.
Right. Now that we have the elements, let's talk about how to structure your policy. And when we're talking about structuring your policy, we have to think about step number 1, which is identifying your goal. Is your goal longevity? If longevity is your thing and you don't care about anything else, then term is going to be the perfect product for you because it's only about death benefit. But here's some of the nuances you have to think about when it comes to term. Is your age. You can only buy a term up to like the age of 72 as an example. So that means if you're 65 years old, you're not going to be able to get a 20-year term policy because of the age cutoff or the age restrictions. The thing to consider with not just term, but all insurance products is the cost of it goes up with age and your health risks. Now, the next goal that you may have is leverage. When we think about leverage, we have to think about a totally different product because term, you wouldn't be able to get any leverage with that product. You'll have to use a permanent product like whole life insurance because it gives you the ability to borrow from that policy. Now, the next thing is going to be liquidity. Liquidity and leverage is the same thing, but liquidity, when do you want that liquidity? Do you want it 5 years from now, or do you want it immediately? These questions are going to dictate the type of policy that you start off with as far as the platform that you use.
Now, I hope with this information that Darius just shared with you, it opened your eyes to realize that, wow, maybe I should really sink my teeth into the next purchase of a life insurance policy because I had no idea that I could have leverage, liquidity, and longevity. We want to paint the picture because it's not just about us putting illustrations on the screen and going through the numbers. It's about you really consciously thinking about the things that you need because this isn't a one-size-fits-all approach. And just because you see people put illustrations online or you see what your mom and your dad are talking about doesn't mean that that's actually going to fit the things that you need specifically, which is why we're breaking this down for you.
Right, and I like that idea because you have to know exactly what you're trying to accomplish. You can't use our story and say, oh, I want to do that, but our details are different from yours. Our experience is different from yours. So you have to be able to communicate that to whoever you're working with or the research that you're doing so that you can understand the foundation or the chassis that you're going to be using to accomplish your goals.
And additionally with that, your age and your health and your budget
is critical.
This is going to be a huge thing to consider with leverage, longevity, and liquidity. Now that we understand our goal, let's talk about design. So if we want to design the policy to align with our goals, we have to take some things into consideration. So if we are just wanting something short term, that's a term policy, there's no design for that. It's just X plus Z equals whatever, and you'll get your death benefit and be on your way.
Right.
If you want a permanent product, like Darius said, whole life insurance, then we have to design it a certain way that have extra benefits and features that come along with it if you choose. So let's go along with a car analogy, right? Because I think this is the best way to get everyone to understand what we're talking about because most people know how to buy cars. So if I want a base model Honda, for example, right, I know it's going to be $20,000. If I want cooling seats and heated seats,
cabin seats,
it gets more expensive, right? And I have more features, right? I've customized it. If I want power windows, like nobody's really cranking these days anymore, right, but there's more features. If I want leather seats, you get the point. If I want these add-ons, it's going to come at a cost.
Right, so if you want a more powerful engine, you'll get a more powerful car, but you're gonna have to sacrifice the gas efficiency.
Love that. Keep that in mind, right? So all of these numbers are just examples. We're not talking about necessarily the cost of a life insurance policy. We just want you to understand how this works. So if I want a whole life insurance policy, a base model whole life insurance policy, it's going to give me death benefit.
Right.
And I will have some liquidity and leverage later on. When we say later on, maybe 3, 4, 5 years down the road. But out of the gate, I get some longevity in the terms of it's a whole life insurance policy, so you're insured your entire life. I get leverage and liquidity that's going to come later. Now, if I want these extra features, if I want the heated and cooling seats and the power windows, aka maybe I want some cash early on, then I'm going to pay for an extra benefit called a rider, RIDERS. This rider allows us to have extra benefits that allow me to customize my policy. So if I want cash sooner, right, I want that liquidity sooner, I can put a rider on my policy called a paid up additions rider, or a PUA, right? And that will allow me to have more cash sooner.
Right. Now, back to the car analogy, this is like putting a souped up engine on your vehicle. But remember, you'll get a faster vehicle, but you're going to give up some of that gas mileage or that efficiency on the back end. So make sure you understand what you're doing when you add something like a paid up addition rider onto your policy, because yes, you have cash value in the very first year and you can use it. But the thing is, you have to know exactly what you're going to use it for, or you just got a souped up engine that you're driving in the HOV lane.
Oh, I love it, in the HOV lane, right? So what are the other features and benefits that you can add to this? There are other riders, and we won't go through the laundry list of them, but some of the most popular ones that I know that we use for our clients are called a terminal illness rider, meaning that when you are a policyholder, when you own that policy, if you are ever diagnosed with a terminal illness, you can leverage a portion of your death benefit to pay for medical expenses. Same thing with a chronic illness rider. If you become chronically diagnosed, you can leverage a piece of your death benefit to pay for those medical bills. So going back to leverage, do I want leverage with these riders? Do I want other benefits to me? If you do, then maybe you're going to look at some of the riders to customize your policy. The other thing is, do I want liquidity? When do I want liquidity? Do I want it tomorrow, or I'm okay with liquidity coming 3 to 5 years down the line?
Right. And let me say a little thing about that liquidity and leverage thing. Back to the souped up engine and gas efficiency.
He's the car guy.
Well, yeah, I am the car guy. See, the thing that I want everyone to understand is that a traditional life insurance policy is going to build up cash value over time.
Let's call it a base model.
A base model
whole life insurance
policy. A base model whole life insurance policy is going to have cash value eventually. It's going to have it at maybe 3, 4, or 5 years. But that's the maximum amount of death benefit you'll be able to get dollar for dollar. Now, taking that same exact dollar and adding a paid up addition rider onto it, you'll be able to get cash value up front. But the death benefit isn't going to be exactly the same. It's going to be a little less because you've divided that dollar into the base and the paid up addition so that you can have that cash up front.
Mm-hmm. And there's other riders, as you were talking about that made me think about it. You also don't, I love that you brought in that you might sacrifice some gas mileage.
Right.
So if you have a paid up additions rider, you may sacrifice some death benefit. Mm-hmm. Something to consider. Is that important to you? You need to know. Also, you don't necessarily have to sacrifice the death benefit because there's a rider called a term rider that you can add to the whole life insurance policy that will give you more death benefit for a specific period of time.
Right.
So you see
how... And for a cost.
You see how this kind of gets a little complicated?
And customizable depending on what you're trying to accomplish.
It's like Legos. We go to the Lego store and everybody's trying to build something different. But the point is we all win because we get what we want. And that's why, again, I'm going to say it again, because we see in the comments, we're like, let's see illustrations, put it on the screen. No, because your situation is different. And if we just show you one example, then everybody's going to say, I want that. And we might not be able to get that to you.
Right.
So that's why you need to understand leverage, liquidity, and longevity. Your age and your health and your budget are going to change all of these aspects.
Right. Now, let me tell you how the age or the health affects this. If you have bad health, what you get is something called a table rating. You get A, B, C, or D, or as an example.
And a table rating is really just saying, like, if we put like a temperature thermometer on the scale, right? You might be standard, then you might be preferred rating, and then super preferred. All this relates to your health as far as like, oh, we want to insure you because you're in good health. So if you stay above the line, that means good for you. The life insurance companies want to insure you. But if you get a table rating, that means after standard, you are down here, my friend. Right. Meaning that, and I'm trying to see myself in the viewfinder, so I'm sorry that I'm covering my mouth. But the point is you are going to be underneath the standard line. And for that, you really need to consider friends and family, because when we're studying your health and you're under the standard line, you should really talk to somebody. Right. Talk to a health professional about your health.
Right, because here's the thing, the insurance company doesn't want to insure you if you are at risk, at high risk, because that means that there's more time, you won't be paying your premiums as long as somebody who's healthy. So the insurance company, of course, wants their funds so that they can provide you the death benefit or whatever the type of policy, customized policy that you created for yourself. They want to provide that for you, but not at the risk of you not paying, and they have to provide you a huge death benefit because you're unhealthy and not taking care of yourself. So at the end of the day, the riders, step number 3, it gives you the ability to add benefits to your policy that serves the goals that you're trying to accomplish in your financial journey.
And it's not just death benefit.
And it's not just death benefit.
Because who knew that you could have your cake and eat it too?
Right.
Because the information that's out there as far as our industry, because we're in the industry, we just know that people basically only really know about term insurance, and that's about it. Right. And that whole life gets a bad rap because it's more expensive. But of course it's more expensive because you got cooled seats, you got the power of steering, you got all the other things. Of course, the other benefits are going to make it more expensive. But the thing to know is...
And because it's permanent.
Yeah, and it's going to insure you for your whole life. So how can you compare apples to oranges? And the thing that we want to make sure that this isn't a biased conversation. Both are going to give you amazing features for what you need it for. So we're not going to demonize one versus the other, because they both provide amazing benefits for what you need. And the thing to note is Darius and I, we own whole life insurance policies and term policies because they both do different things for us.
Right, and the thing that we like most about life insurance, not because we're agencies, but it gives us control. Whenever we go to leverage our policies, we decide when we pay those premiums back, or our investments decide when we pay those loans back. Yeah. When we borrow money from a financial institution like the bank, they dictate when we pay those loans back. So it gives us a level of control so that we can best benefit from the investments that we make. So let's say our real estate investment doesn't pay out for another 3 years, then we don't have to be worried about when that money is going to pay back or how we maintain minimums and things of that nature.
Because we've leveraged our loan from using leverage, we've leveraged the liquidity from a life insurance policy to make investments. And real quick tip before we go through the rest of it, I can hear some people out there going, well, why would you have term and whole life policies? Because going back to that car design, we know with whole life insurance policies, and because we have liquidity and leverage, we have sacrificed some death benefit. With that one product. But because we're husband and wife and we have a family, we recognize that we don't really want to sacrifice the death benefit capabilities. And so that's why we have term insurance on board, because that gives us the most amount of coverage for the cheapest amount. And what we can talk to in a little bit more detail later is the fact that we can still convert our term life insurance into whole life insurance in the future. We're just essentially earmarking larger bits of death benefit right now while we're at the youngest age we'll ever be, and we're going to use that in the future. And that's more for later.
Okay. I was going to tell them the benefit of that. But let's go into step number 4. We'll come back to that. Step number 4 is how you're going to pay for it. You want to make sure that you're able to pay for your life insurance policy early, consistently, and intentionally.
You hear that? Consistently and intentionally.
Right. Because here's the thing. If you don't pay your policy, if you don't manage this system correctly, then it could implode on you. And then you have nothing to show for it. You don't want that to happen. The things that we want you to understand when it comes to your policy and working with a good agent is the fact that if you have some financial issue come up, call your agent. Because there's different things that are levers that can be pulled to get you through that that rough patch for a specific period of time.
As it pertains to paying your premium.
Right.
Right. We never want you to lose the protection that you have. So if you are having some financial hardships, you let your agent know, and your agent should be able to work some flexibilities out for you.
And that's the thing. A lot of people think that when they have some financial issues, it's something that they have to deal with on their own. But there's a number of different financial experts that you can call to help you get through your situation. And when it's life insurance, call your agent.
Mm-hmm. So let's move on to basically the next step, which is if I want leverage and liquidity and I'm thinking about buying a whole life insurance policy, the things that we really want you to consider, because now you're coming into our zone, right? We're agents, we have an agency, and the things that we want you to consider as a potential client, not only for us, but for other agents out there, is that if you want to borrow from the cash value, you have to borrow with a plan. You have to be intentional about it. Don't just get a policy because you're like, oh my gosh, I have the cash and now I can spend it. If you are a financial train wreck, and I mean that lovingly, meaning you don't have your numbers in order, do not borrow from the policy, because it's just going to cause more grief for you.
Right.
Because you have access to more cash with not a plan to pay it back. Because yes, I said borrow. That means you have to pay the money back to the life insurance company plus interest. Mm-hmm. So the only way you should be borrowing any money from your life insurance policy, leveraging the liquidity, is so that you're making more money than what it cost you to borrow.
Right.
It's as simple as that. So do not borrow irresponsibly. Have a plan and know when you're going to pay the policy back.
Right. And I would say the most responsible thing to do if you're a financial train wreck is to buy term.
Yes.
Buy term until you get better financial habits, and then you convert that term policy into whole life. Because you won't have to go through another medical exam. You'll just be able to convert it at that time or age without having to go through any medical. So it's an easy transition, especially when you're mentally prepared for that responsibility.
So here's a real life example. Darius and I, with one of our policies, we had $30,000 of cash value in it. And this was several years ago. This was an example that we've shared in our community and also on YouTube before. It had $30,000 of cash value in it. And an investment came our way that the starting point was $25,000. We could get in at $25,000 to invest in a warehouse. A bunch of investors were coming together, putting their funds together to buy this warehouse. So we got in at $25,000, but we knew, right, that the insurance company was going to charge us 5% simple interest for the $25,000, right? Every year, it compounds every year that loan is outstanding. We knew that we could invest that $25,000 at 30%, right? So that gap between 5 and 30 is pretty large. So that gives us a huge wiggle room of being able to create a profit from borrowing from the life insurance company, borrowing $25,000, leveraging our policy, because now our policy becomes the collateral, the guaranteed payback for the life insurance company, right? We invest it at 30%. And what we get back is more than what it cost us to have it outstanding.
Right. So we didn't have to change anything in what we were doing. We had access to cash, and we leveraged that access to get in this investment deal. The only thing we maintained was the insurance premiums, because that's what we have to maintain anyway until we have additional investments that's kicking in so that we can have that pay for the premium.
And I know my investors out there, how long was the loan outstanding? 1 year. Just 1 year. Amazon actually ended up buying the warehouse and we got our money back quickly. So it worked out even sooner or better than we could have hoped. But that's an example of how you borrow from your policy. The example of how not to borrow the policy is you borrow it, you spend it, and then you don't know how you're going to pay it back. And now every year you're on the hook for interest and still the principal repayment.
Yeah, an example of that is borrowing it to buy clothes or consume.
Yeah.
There's no return on investment for something
buy
that you
term
consume.
If that's what you're going to do.
Yes, buy term. Buy a term policy.
Buy term and consume the difference.
Consume the difference. Buy term and consume the difference.
All right, now common mistakes to avoid. Let's talk about this. I would say just not understanding going into this. You meet with an agent and you just sign willy-nilly on the dotted line and you just think that this is just a death benefit play. I would say that's a common mistakes to avoid. So educate yourself. Watch the Wealth Nation channel. Watch other people out there. We have a Financial Freedom for Your Whole Life onboarding program where you can actually sit, watch more on-demand videos that Darius and I have created so that you can understand how to buy your next policy. The next common mistake I already talked about is borrowing irresponsibly. We never want that to happen. And then then other thing too,
like borrowing too early without a plan.
Yeah, without a plan. And then the caveat to that is not having a repayment plan, right? So now this becomes a financial burden because you have no idea how you're going to make the payments back.
Oh, another problem is thinking that your policy is going to be your return on your investment. The policy itself isn't the return on investment. A policy is a life insurance product. It provides death benefit. We're just using it as a tool to make investments, to leverage, to use the liquidity. We're using it for those things. It's not the vehicle itself that is going to be giving us a return on investment. So you can't compare a life insurance product to a 401k or retirement plan because it's completely
or the S&P 500.
Or the S&P 500.
It's not going to do any of that.
It's not going to do anything. It's not going to do any of that. But when you use that cash value to make an investment at a higher rate than what it cost you, now we're talking about something different.
Now let's break down how you can maintain your policies like a pro, right? So we talked about how you design your next policy. This is how you keep it alive. So going back to the car analogy, right? When you buy a car, what do you have to do? You got to maintain it, don't you? You got to get your oil changes. You got to get your registration every year. You got to get your emissions every year. You got to keep up with it, right? It's not just a one and done situation. The same thing with your policy. There are annual reviews that you need to be doing with your agent. Pick up the phone, call them if you have questions.
No, better. If you're a Wealth Nation client, answer your phone. We give you a phone call, email, and we even send videos to do your annual reviews because people's financial situation changes. And we want to make sure that you are still in alignment with what you said that you wanted to accomplish when you initially started talking to us. And the biggest thing that we want to do is have in-force illustrations so we can have a conversation of how your policy is performing right now.
From when we first designed it. So going back to your annual reviews, make sure you schedule those, show up for them. If you have questions, call your agent, right? Don't just call them when stuff hits the fan. Call them at any point. There's tune-ups, there's things that you might need a refresher on. Call, stay on top of it. Don't expect that you get this policy and now, everything's back in your agent's hands and they're supposed to drive this thing for you. No, it's your vehicle. You're supposed to take ownership of it and make sure that you do the necessary tune-ups and understand again why you got this in the first place.
The next thing you want to do is make sure that you reassess your goals as your income increases, because as your income increases, that increases your net worth, which means that you need to cover more of your life with life insurance. The reason being, you pass away, you've already established your life on $150,000 annually. So what's going to happen is as that net worth increases, the lifestyle that you want your family to maintain is also going to increase.
So going back to the car analogy, you're not going to insure a Ferrari with a Honda budget.
Right.
Right? You want that whole Ferrari to be covered because your lifestyle has changed. And going back to the point of this is that you have to think about this as your financial ecosystem. It needs attention in order for you to create perfection. It always needs attention for you to create perfection. So be intentional with the products that you are bringing on board to create financial freedom for yourself.
Right. And it also needs a process. You have to always make sure you're able to maintain your policy, manage your policy, which means paying back what you've borrowed. Because everything has a cost, including borrowing money from the insurance company. It has a cost. It's a cost when you get money out of your savings account because you have to replace that money. You want to make sure that you treat every dollar the way it's supposed to be treated, like it's your money. And when it's your money, you always want it back. So make sure you put yourself in the right system in order to make sure that you maintain and manage the system correctly, because you're teaching this system to the next generation.
All right, Wealth Nation, now here is the point where we talk about the things that we wish we knew prior to us starting our policies, and we're 10 years into this process, okay? What I wish I knew back then is 10 years ago, was the cheapest to insure 10 years ago. I'm more expensive to insure now because I'm 10 years older, and that's going to continue to change. So what I know right now is that I am putting way more money into the death benefit piece of my life insurance policies than I did 10 years ago. Because again, recognizing now Darius and I have had children, now we make more money, and realizing that if any of us were to go, we want as much money as possible. So for us right now, it isn't about the immediate gratification of having cash or liquidity right now. It's about thinking about longevity and stuffing our stocking stuffer as much as we possibly can, with the ability to get as much money as we can for the least amount, if that makes sense.
Yeah.
So going back to like our whole life insurance policies for me, and Darius will share his as well. For me, I wish that I added more death benefit into my life insurance policies as opposed to sacrificing it for having as much cash as possible. Because for me, the older I get, the more I realize I just want more death benefit.
Yeah, I would say that's similar for me. 10 years into it, I wouldn't put as much cash value into the policy. Since we have 8 of them, I would have just put cash value into like the first 2, and then the other ones just buy traditional death benefit or traditional whole life insurance products, because we don't need as much cash value as we actually have. The cash value is good in the front end, but what happened when you use the system is you have more cash than you have things to do with it.
And places to put it. Yeah. So that for me, that's what I would say. The other thing too is I would have bought up a ton of term. Like 10 years ago, I would have maxed myself out with term 10 years ago, because again, it was the cheapest that it will ever be.
It's still cheap now.
Yeah. I'm not saying that we're old by any stretch, but I'm just saying 10 years ago, it would have been a lot cheaper, and that's still more money that I would be able to convert into the future me 10 years from now, that I could add into more policies.
Yeah. Another thing for me is that life insurance doesn't fix everything.
Ooh.
Buying a life insurance product, like if you come to a financial situation, you don't just add another life insurance product onto it. There's other products that you can use for different things. So I know for me, right now we actually have disability insurance. Disability insurance is great because you can sneeze too hard and be out of work, especially as you get older. And I didn't think about that years from now, but I wish I did think about it a lot sooner, because disability insurance is also cheaper when you're younger. And it helps you transition and protect your income so that you don't have to tap into your life insurance policy for an emergency fund. It's good for an emergency fund, but if I was to get hurt, I'd rather use that disability policy than my life insurance policy, because I want to only use my life insurance policy for revenue generating investments.
Yeah, I'm glad that you brought that in. So educating myself on other insurance products actually goes back to that. So disability insurance has been something newer to us, also long-term care insurance, because we know ourselves, many people through our family have been through the nursing home hospice chain.
Yeah.
Right? And that is super expensive. And we know that is going to eat into income at some point, right? If any of us either need those facilities, we have to make sure that we are financially prepared from an income standpoint to make sure that we can have somebody to help wipe our butt when we need it, so if somebody's not here. And if you aren't planned for that, you need to start putting your ears to the street and figuring out what long-term benefits that you can also benefit from. Because what I find in our industry is, again, we just talk about term insurance, generally speaking, and we need to do more to educate the public as far as long-term care insurance and disability insurance, and not just the death benefit things, because there's a lot that happens to us as we go throughout our lives, being hurt, being accidentally injured, aging. So those are things that I wish I was more aware of younger.
Right, and this is also conversations you need to have with your significant other, because you may not want to do some of the things that a long-term care provider would do, like taking care of when they use the bathroom on themselves. Like, there's things to consider. I just want to be there for support. I'd rather hire somebody else to do those things, but that's real talk. Like
that's good to know.
Well, I'm just saying, like, we're able to have these conversations, but you should also be able to have these frank conversations with your significant other, because as we age, we're the youngest in our families, and we've seen how age and people transition, and some people don't age gracefully or nicely. So it's something to take into consideration.
I'll wipe your butt though, babe. I won't hire somebody else to do it.
You say that now. Say it for YouTube. Tell YouTube anything.
All right, so let's go back to the point of this video was for you to design your policy with maximum cash. I hope that we settled that with this video, because the point was, it's not just going to be, here it is, throw 2 sticks at it and it's going to work. There are many more benefits that come along with a life insurance policy than just throwing cash at it. So I hope today gave you an understanding of really things that you should think about: longevity, liquidity, and leverage.
So if leverage, longevity, and liquidity are the 3 L's that you want to continue watching videos on, then check out our next video where we talk about the 4 roles of banking.
And don't forget to own your own lifestyle.
Or someone else will.